AMD is currently $83 a share, but down 22% over the last year. What we're going to be doing is going to my stock summary spreadsheet, looking at the discounted free cash flow model, the Ben Graham model, and the comparable companies model to give my fair value of AMD and seeing if this is the right time to buy. Now, as I said at the start of the video, it is currently at $83 and down 22% on the year. But if we look at the year to date, it is actually up about 30%. And if we go to the last 5 years, despite this stock being down from its all-time highs around about 50%, it is still up 622%. So this has been a company that's been on an absolutely meteoric rise. And if we compare it to the market at the similar time, market up about 40% in that time, AMD up 600%. Now, yes, it is on a bit of a dip. We know the stock can get to around about 150 before, so let's see if this stock can increase again. We're going to be looking at my stock summary sheet first, talking about some of the financials here. So currently, PE ratio of AMD is 98.73. That is very, very high, much higher than the average of the market, which has 21. So that is a fail. Next, you want to be seeing if the revenue is increasing, and obviously the revenue is all the sales of the company. And revenue is up dramatically. 6.7 billion this time 4 years ago is now 23.6, which is its all-time high. Obviously, that is increasing. 6.7, 9.7, big jump to 16, and once again, a massive jump to 23.6. So that is a pass. Next, you want to see if the profit is increasing, and this is the sales minus everything else. And yes, profit is increasing, but it went from 341 million to 1.3 billion. Yes, that is good to see, but as you can see, it was up to 2.5 and 3.1 and is back down to 1.3. So yes, still is increasing massively, but it is down from the prior 2 years. Please give a like on the video if you enjoyed it. Let's try and get this video to 10 likes. Helps me out as always. And let's get on to the next step, which is shares outstanding decreasing. And yes, they are increasing 1 billion to 1.5. This is a massive, massive increase. So this is a fail. But as I say, let's go have a look at the stock price over that time. They've been issuing more shares. The stock price has been rising. So when they were issuing shares at the back end of 21-22, stock, they were issuing at $150 a share. And now the company has dropped since then. So if they want, they can now start buying back their shares if they think their company is undervalued. But good time to issue more shares. You can gain capital when the share price is on a massive rise. And finally, is the free cash flow increasing? Yes, it is. 267 million to 3.1 billion. Now, interestingly enough, 267, 777, 3.2, and 3.1. So down slightly from the prior year, but still up massively. Free cash flow ratio, I'm not going to say this is great based on what we've seen, 42.3, but still generating positive free cash flow. So the first model we're going to look at is the discounted free cash flow model. This calculates the future free cash flows, discounts them to today's value, and then gives you a value of the company based on that. I don't think this model will like it, which is why we have a couple of different ones. Yes, as you can see here, $51 a share, $52 a share, which is obviously a lot less than the 83 it is currently valuated at. If we look at the numbers here, you can see that the future free cash flows estimated seem to be quite fair. They are growing. If we compare to the revenue growth rates, analysts are expecting a lot less growth over the next few years. They've been averaging about 30%. So let's be on a bit more of the bullish side, bring that to about 30%. Now a $57 stock. The net income margins, you can see 5%, 25, 20, and 5. So I think an estimate in the middle is about fair. And then the free cash flow rate, this is with the lower number with the 30%. So what we'll do is we'll take a slightly higher average, which is 139%, so 140. Still, this is a $70 stock based on a very discounted free cash flow estimate, which is a bit more on the bullish side. So we'll look at the Ben Graham's model. This is a type of model which is used to value growth stocks created by Ben Graham himself. What it does is it takes the company's 12 months earnings, compares against a no growth company based on the expected growth of the earnings per share over the next 10 to 7 years. the AAA bond yield, and then the current bond yield. So firstly, we will have a look at what analysts are expecting for the growth of AMD over the next 5 years. And you can see it was about, well, they're estimating about 10.12%. 72% for the past 5 years, though. So if AMD can continue that, we'll have a little compare of the numbers here. But yes, 10.12%, which we are adding here, 10.12%. And next, what we will do is look at the AAA bond yield, currently 4.56. This will eat into it a little bit, but as we can see, this is where it's jumped up from the bottom of 2020. So what does the Ben Graham formula give us as an estimate? $20 a share. So that is a lot lower as well. As I said, let's just estimate that if AMD could continue their growth, which I doubt they can, then they'd be $130 stock if they could repeat the last 5 years. But that is very unrealistic. So both of these models are saying it is not a buy right now. Discounted free cash flow model says the stock can go, if it gets that $70 range, then it would be a buy. Graham's model doesn't like it at all. This is because of those low earnings per share. So the final valuation we're looking at is the comparable companies valuation. So I have added in companies that I think are comparable to AMD, which is NVIDIA. One of its direct competitors, they were two stocks that were going head to head over the last couple of years, IBM and Intel. So what are we looking at here? Well, this is calculating some different metrics here. EV to revenue, EV to EBITDA, EV to PE ratio as well. Then we're going to take the high, the average, the median, the low, and then calculate different types of valuations based on the EV to revenue, EV to EBITDA, and EV to PE. So the EV is the enterprise value of the company, which is the equity value of the market cap, add the net debt. If you wanted to buy the entire company, that is what you'd have to pay. Obviously, revenue, we know what revenue is. EBITDA is earnings before interest, tax, depreciation, and amortization. Easy for me to say. And then the net income is the profit. So these are the values of these four companies. So first we'll look at the high. For EV to revenue, what do we want to see? Well, we want to see that the lower the number is, the lower the company is valued, which is why you can see IBM and Intel are the lowest. NVIDIA is massively high. This is because obviously the enterprise value of NVIDIA is still $570 billion compared to the other companies, which are pretty close. So NVIDIA has the highest. So AMD is towards the lower side, which is obviously quite good. Then we want to look at EV to EBITDA. This is once again the lower EV to EBITDA is better. 29, 12, and 3, with NVIDIA being the highest once again. And then finally, PE ratio. AMD's PE ratio is on the higher side, but you can see it's in there. So we've got the averages here, 8, 33, 97. And this then calculates the actual stock price, which is 82, and then the implied value per share based on these three estimates. So let's have a look at what that says. So EV to revenue, that gives you a share price of around about $115 a share, which would say it is undervalued at the minute. Now this is with the comparison to NVIDIA. So if NVIDIA is worth what it is, then really AMD should be as well. Next we look at the EV to EBITDA. Similar story again, this is looking at the averages, which is 33, $94 a share. And then finally the PE ratio, because of the low PEs of Intel, and previously IBM, which used to be a lot lower, but as you can see it's 61. This is saying the stock is overvalued. So based on average of those three, that gives us about $96 a share. So based on the other companies, it does look a little bit undervalued, and especially with the valuation of NVIDIA. Right guys, thanks for watching. Please give a like on the video if you enjoyed it, subscribe if you're not already, and I'll catch you guys next time.